I want to take you through now, if I could. We can bring the lights back up if you want. I would take you through a PowerPoint that just very quickly will give you the benefit of the survey responses. We sent out a survey to students all across campus, asking them a few basic questions about where they are in terms of this crisis. And so this is kind of how it broke down. Roughly a little over 2/3 women, 1/3 men. In terms of graduation, kind of more responses from seniors working their way down to least amount of responses from freshmen, perhaps not surprising there. Oops, darn it, wrong button, let's go. Okay, how closely have you been following the economic crisis and the government's response? Extremely closely. A few of you are addicted. The not at all, 20%. The somewhat closely, which I would interpret to mean nearly not at all, but I couldn't really say that, is about half, and then closely about a quarter. How are you feeling? Very concerned, 7%, watching changes daily. Not concerned at all, 15%, taking the long view, and concerned but not panicking, about 3/4. How informed are you about the current economic crisis? Not very informed, nearly 20%, somewhat informed, 53%, informed and actively seeking more information, 23%, and very informed, 5%. How important is it to you that we understand this? Only 0 of you said not important at all. 13% said somewhat important, but not going to lose any sleep. 70% in sort of the middle category, important, I know this will affect me at some point. And 17%, very important, expected direct impact. Interesting slide in terms of where people get their news. 1% from the Daily Show, Colbert Report. The 17% from cable news, only 5% from network news. Online news source is the biggest one up there, 35%. I can't quite read the other one. You know, newspapers, about 20%, and friends and family, 21%. The graph's a little hard to read, but we asked students to rank in order their biggest sense of concerns, and what you really want to, the smaller the bar, the higher the concern. So as you might guess, the state of the job market got the most concern. Financing my education was second. Stability of the banking system, interestingly, number 3rd. Direction of the stock market is 4th, and then the increasing national debt was 5th, still significant, but not in the top 3. Have your financial habits changed? About 1/3 said yes, a little more than 1/3 said yes, 2/3 said no. In fairness to the students, I read some of the comments on this. Some of the comments were, how much cheaper than cheap can you get? I already never spend anything, so this may not be in a reflection that they don't care. Are you concerned, and this I think is an important slide, important for the institution, are you concerned that the current economic crisis will impact your ability to complete your education? And nearly 40% are saying that. I mean, I know that I speak for the entire institution that we really, really want to reassure students along the way that we're going to do everything we can to work with you to ensure that you can complete your education. And having started here, we want you to finish strong, but we are sensitive to this concern, and this is a big deal. So, and that's it. Those are the survey results that came in. Let me invite, to kind of elaborate on that, both Craig and Jordan to come on up. And while they're coming up, let me tell you a little bit about them. Jordan has been in financial aid since 1994, first working at Seattle University and Seattle Central Community College in a variety of positions, from data entry to loan processing to counselor to director. Jordan received his master's degree in public administration in 2004 from Seattle University. In February 2004, Jordan became Director of Student Financial Services at SPU. He's an active member of the state, regional, and national financial aid associations. And relevant to today's discussion, Jordan is also in the midst of repaying his own graduate student loans. So please join me in welcoming Jordan.
Thank you very much. Thank you, Dean Van Duzer, and really good to see all you out there this afternoon, especially the students. I'm sure this portion about student loans and the future concerns around the job market will definitely be something you're interested in. I really do appreciate this opportunity, and I hope that I'm going to be able to give you some clarity and a little bit of hope as well about your concerns for the future and about student loans in general. Let's see if I get this right. Middle? Bottom. Perfect, thank you. So obviously we need to work on our PowerPoint skills in SFS, or at least the director does. I see my friends out there. There's a few things I want to go over today, and I want to touch briefly on 5 main things. When did student loans begin to be affected by the credit market downturn, and when it was identified, what was the response? What did happen nationally? What did schools and most importantly, what did Congress start to do when they saw this? What have been the effects nationally? So based upon that response and based upon what Dean Van Duzer and Dr. Downey just talked about, what did happen around student loans? And more specifically to our campus, what has been impacted at Seattle Pacific? And hopefully I can give a little bit of a light in terms of what we expect to have happen in the future around student loans and job opportunities. So when did the student loans start to feel the crunch? It was actually a little bit sooner than what you've come to learn about the credit market. So 2 things happened in a really relatively short period of time around student loans. The first was the College Cost Reduction and Access Act, which was passed in October of 2007. This was passed by Congress because there has been a number of years of which bank-based student loans called the Federal Family Education Loan Program recorded banner profits. They did really well, maybe for some of the reasons that Dean Van Duzer talked about, but it looked like they're doing well. At the same time, there was kind of a political maelstrom happening through the state attorney general in New York State. And he started to look out and say, you know what, there's some things going on that may not be great for students. His belief was that there maybe was kickbacks happening with student loans and institutions. By the way, Seattle Pacific never was part of that type of stuff. And to be honest with you, it was about 4 student financial aid administrators in the whole country out of 3,000. But in politics, unfortunately, perception is reality. And so while that was going on, it gained momentum around this bill, which said, let's slice the subsidies for the bank-based lenders because they're doing well and it looks like they may be spending the money where they should not. So in October 2007, the subsidies were cut, which were supposed to be an incentive for banks to participate in these loan programs. Within a couple months after that, the credit crunch started to happen. So what we had was banks being more open and exposed to not being able to get credit and feeling the pinch. So they became much more difficult to get capital to lend to students, sometimes impossible, or in fact really expensive. So the cost to get that money to lend it to students cost more than it would be for the students to repay it. So beginning about February 2008, we saw the first wave of lenders starting to exit the program. These were mostly not-for-profit lenders who, by the way, didn't participate in any of the things that other lenders and some schools were accused of, but because they were operated right on the margins, really started to feel the effect of the credit. And also those lenders that kind of just hung a shingle or created a website saying, you know what, here's a student loan for you, come and get it, and that's all they did. They were not like your traditional, what we call brick and mortar banks, where you would walk into a branch and they had a much diversified portfolio of business. So those, the type of lenders who, that's all they did with student loans, they started to actually close shop. So what was the national response? Well, for a while there, it was kind of quiet right around February. And then kind of a shot came across the Congress's bow. Those of you students who borrow and have a loan, you may recognize the name Sallie Mae. Sallie Mae is a large student lender, about $10 billion, the largest in the country. And they started to throw out little comments in the media saying, you know what, if things keep going, we're not sure we're going to be able to continue participation in the student loan market. That got a lot of people's attention. And it's very important because about 65% of all federal loans operate through the Federal Family Education Loan Program, operate through banks. So if the largest one of those is saying, we're going to have some trouble here, something needed to happen. And so believe it or not, the federal government took action. Many times when you hear that phrase, people run and hide. You know, the federal government taking action through the history has maybe not necessarily been a good thing. But believe it or not, some partisanship was put aside. The executive branch and the congressional branch actually got together and put together the Ensuring Access to Student Loans Act in about 4 weeks. May 2007 it was passed. It was actually a fairly good bill. And it did 3 main things. It authorized the Department of Education to purchase loans from banks who felt like they were on the margins and needed capital to relend to students. It also did some other things. There's some companies called guarantors that guarantee the loan. They actually pick it up and do delinquency counseling and default management counseling, things like that. And this bill gave them authorization to buy those loans too. And in a pinch, it gave the opportunity to actually for schools to be a lender. But the primary purpose was for the Department of Education to buy those loans. Second, it increased federal staffer loans by about $2,000 annually. So for students at each grade level, you have a certain maximum you can borrow in staffer loans. It had been sitting around at that level since about 1992, and then increased a little bit for freshmen and sophomores the last couple of years. Well, so there's a couple of things going on. One, they knew cost of education was outpacing any increases around that, and there was this credit crunch. So this was a nod to that, and it increased by 2,000. And because the government knew that parents are involved definitely in higher education costs, it loosened the credit check for the Parent Plus loan. And what that means is that if parents are having difficulty paying those mortgages, and maybe the subprime mortgages that we just had a nice chuckle about, that would not be a reason to be denied a Parent Plus loan for education. Additionally, if parents wanted to and asked for it, they could delay payments on that Parent Plus loan for 6 months after their student graduates, which wasn't in place before. So this act addressed mostly the federal loans. The $2,000 increase was a nod to the fact that not only have they not been increased for a number of years, but there's actually this other loan stuff happening called private student loans. And some students take those private loans and they're not guaranteed, and those were also starting to be affected by the credit market and credit crunch. So what were the effects of that response? What happened after that? Well, really the emergency legislation that happened it basically saved that family federal education loan program. With Sallie Mae saying those things, it really stepped up, and a number of banks have taken advantage of the government being willing to buy those loans. And it has saved that for many schools. Seattle Pacific, I'll talk about this in a moment, is in a much better place than many other schools in the country. Schools that have relatively high default rates or have a very transient population, that is, students come and go, community colleges, public schools. Some lenders, even with this act, said, your students are too risky. We're not borrowing to your students at all. So some community colleges, if you have any friends in there, may say, you know what, Citibank left, but Citibank is still with Seattle Pacific. Why is that? Well, Citibank decided that the risk was too great to lend there. There's a big debate in student financial aid world about whether how appropriate that is, right or wrong, but the question of whether it's a sound business decision is not ours to make as student financial aid administrators, it's the banks. So it did save the program, but there really is less lender participation. As of last week, when I checked, there's about 137 lenders that closed their doors in terms of student loans. They stopped making student loans. But I want to put that into context for you a little bit. In 2006, there was 2,000 lenders. So the percentage of those affected is pretty small, and the impact is relatively small, unless, unfortunately, you're in a community college or some college that has a relatively high default rate. In terms of private loans, about 36 loan products have stopped participating. Now, there weren't a ton of those entities participating in private loans. That probably had a little bit more of an impact than the 137 shutting down. Borrower benefits decreased. And so what that means is, in order to get customers, banks would say, you know, you choose me, US Bank, and if you make 36 on-time payments, 2% of your principal will be canceled. Or we'll reduce your interest rate by X percent. Well, because the margins are so small, they're selling sometimes the Department of Education and they're not making the profits they used to, and the subsidies have been cut themselves. Banks have said, forget about it. We're just straight across, here's the loan, here's the interest rate, you pay it. So the cost of the loan has gone up in the federal education, the Family Federal Education Loan Program because of the credit crunch and those subsidy cuts. I have seen some lenders still doing those things, but usually it's with a carrot. They're dangled. If you are, for example, a Wells Fargo banking customer, you also may receive some benefits if you choose to do a student loan with them as well. And for private loans, which, as I said, are not guaranteed by the federal government, it is essentially the lender's risk entirely. They have said, you're going to have to meet some much more stringent credit requirements before we agree to take that risk. And in fact, many have said, just don't apply with us unless you have a cosigner. Students, unless your parent or somebody, older sibling or somebody who will co-sign that loan with you, we're probably not going to look at it. So the credit requirements definitely tightened. And additionally, if you're approved, the likelihood of their interest rate will be the same as it was 2 years ago is not true. It's higher. The risk is higher, so they want more interest up front, and there may be some fees associated with that loan. So this is kind of what's happening nationally, and these things are still kind of working themselves out. We get email updates daily, and we make sure that how that will affect our students, if there's interest rates on the rise, if the credit requirements are happening, and the volatility around the private loans is definitely occurring. So the impact at Seattle Pacific. We have been impacted, but not as greatly, as I said, as other schools. In student financial services, just to let you know a little bit of our process, we ask lenders annually a process called requests for information. We ask lenders about their benefits, their customer service, their ease of application, their processing standards. When we get that information, we evaluate them and we rank them according to how well they'll serve the needs of our students. And at the beginning of the year, we presented to those eligible students who were interested in a Stafford loan, an eligible or a private loan, about 10 federal loan providers and 11 private loan providers that we said, you know what, these folks did a pretty good job. You can apply quickly with them. Their benefits are pretty strong. We've had good track record of customer service. Well, since our list began at the beginning of this year, we've lost 2 lenders in the federal loan list and 5 in the private loan list. So you could see that the private loans are much more volatile because the risk is all upon the bank. So that's one way that we have been in fact affected. Also, it is true for Seattle Pacific students as it is for any other student in the country. The benefits really have dried up. They've kind of gone away, and it's very rare that you see the borrow benefits so that the real cost of the loan is actually what you see at the annual percentage rate of the interest rate is true to that loan. The good thing is, and most importantly for you students out there, is that you all remain really attractive customers to banks. And it's really due in part because of the wonderful history of Seattle Pacific students honoring their debt in the past. So we just received our default rate, which means students are not able to pay that back, from 2006. So those students who graduated in 2006, what's the percentage of those at Seattle Pacific that went into default within 2 years? 0.6%. Not even 1% of Seattle Pacific students went into default. The national average for private universities is 2.1. So very low. So you could see a lender, when they're thinking about risk for private loans, they're like, oh, 0.6%, that's pretty good. We're not going to change much when we deal with Seattle Pacific, and that's what we've experienced in the private loans. So we have not seen an increase in private loan denials, but we have seen a little bit of the decrease in the borrow benefits that you would experience. So a little bit about the immediate future. And as you've heard a little bit, it's somewhat unknown, some of these things around the credit markets. So although this past year's been a little bit difficult, I really don't see a large disruption happening within the federal student loan market within the next year or so. Yet there have been some significant layoffs in the student loan industry. Nationally, there's been about 6,200 student loan employees that have been laid off. So that is unfortunate for them and their families. That's a very difficult thing for them. But in terms of how it impacts Seattle Pacific, that's something that in SFS we have to monitor. We want to make sure that what they told us at the very beginning of the request for information, that they're going to provide excellent service, they're going to be able to respond quickly to student questions and deliver money fast to your account, still holds true. And it may not for some lenders who have had significant cuts in their staffing. So that is a concern that we look out for ongoing. The hopeful news is that the act that I talked about, the Insuring Student Loans Act, has been extended. It's quite obvious that the credit issues are still occurring, and it's been extended through July of 2010. And in the recent bailout, the $700 billion, there's some rather vague language in there that says the Treasury Department could, in fact, purchase more student loans if they see fit. And the interesting part there is it doesn't necessarily define that to be federal loans only. So it's quite possible that the private loan market could be positively impacted by that bailout bill. Federal loans still remain accessible. The Parent Plus loan is a much more reasonable option for your parents. So students, if you're thinking about those things, that's something to discuss with mom and dad. Our website has a lot of information on there. Most of our Seattle Pacific students, Seattle Pacific University students who may need additional funding will have access to those private lending if they need it. Many of our students have already taken advantage of the additional $2,000 in the Stafford loan. And for those of you that are concerned about employment, your work life beyond Seattle Pacific, you'll probably be interested in these few nuggets of information. According to the National Association of Colleges and Employers, currently hiring rates are expected to be about the same this year as they were last year. The caveat there is that there is more students going to be graduating this year than last year, so it will be a competitive market. There are some downturns expected in the job market. Not surprisingly, the financial industry is going to have a downturn in the market, as well as manufacturing and construction. If we go back to this mortgage boom, it really revolved around home ownership and the building. Matter of fact, as I drive to church every Sunday, I go by a number of lots that were leveled and ready to be developed about a year ago. And what do they look like now? Big parks, this green spaces. Please buy this land. It hasn't happened. So construction is definitely one of the places where the jobs have downturn. But be assured by this, hiring is supposed to remain strong in accounting, public service, healthcare, education, and technology. So I know there's some great programs here that you all are learning in, and hopefully will get great skills to be able to market yourself there. The federal government also expects to do significant hiring in the upcoming year as baby boomers would continue to retire at faster rates. There would be jobs available in the federal government. So my advice to you, if you're concerned about jobs, whether that's this year or the year to come, a good job search strategy is absolutely important, as well as gaining experience. And Seattle Pacific is a great place to do that. I strongly encourage students to visit the Career Development Center, who will be able to help you find internships, if necessary, and to expand your experience, to help you organize a job search, and just give a lot of great advice around that process. And if you're eligible for work study, I really encourage you to participate in work study. Although we've heard in the media around Washington State that there's kind of a hiring freeze, you've heard, in the Washington State government, well, there's a state work study program that's not affected by that. There is no hiring freeze for the state work study program. So if you're eligible for work study, I really encourage you to get off campus, participate in the work study program. The statistics bear out that 1 in 5 positions in the state work study program turn into full-time work. So that is a great opportunity. And if you're interested in that, again, our website has great information. So the key is that the more you make yourself marketable, the greater chance you have to landing that first job. So finally, some contact information. I talked about our website a little bit and Career Development Center, but here is where our offices are located. Our website's email address and phone number. And the the website rather for Student Financial Services has a lot of information around the student loans, a little bit more detail on the parent loan as well as alternative loans. And I know the Career Development Center website is pretty snazzy and has a lot of great information on there too. So that's my formal, so thank you very much.
I tell you what, let's, in terms of timing, let's skip any questions that may still be coming. There aren't any sitting here at the moment. And let me introduce to you our last panel member, Craig Kispert. Craig has been at Seattle Pacific since 1993 and is currently the Associate Vice President for Business and Finance, having served previously as the Assistant Controller, Director of Finance, Executive Director of Finance, and Assistant Vice President for Finance and Budget at SPU. He's responsible for the operational aspects of the financial and budget affairs of the university, risk management, contract review, and auxiliary operations, including campus housing, food service, conference services, mailing and printing, the Camp Casey Conference Center. He has overseen the annual financial statement audit process, review of internal controls and financial policies, and has worked closely with the Vice President for Business and Planning in each of the university's tax-exempt bond issuances. He has an undergraduate degree in finance from SPU, an MBA with a management emphasis from Seattle University, and is a CPA in the state of Washington. And before coming to SPU, he worked in public relations and operational analysis in the Seattle branch of the Federal Reserve Bank of San Francisco, and as a cost accountant with the Boeing Company. He's a member of both the Washington Society of CPAs and the American Institute of CPAs. Please join me in welcoming Craig Kispert.
Thank you. I realize I'm the last one on the agenda, so I'll try and be clear with these. And I thought about how could I make some cool slides with lots of colors and graphics for what I'm going to talk about, and didn't come up with any ideas, so you're just going to have to bear with listening to me talk. What I've been asked to talk about this afternoon is where are the rub points for SPU as an institution relative to everything that's gone on. You heard the president talk earlier that as an institution, we're in a fine place right now, and I just want to talk about what are some of the things that we've been watching well over the last year as some of this has started to unfold. There's really four primary areas that we've kind of identified rub points. The first one is with liquidity. What is liquidity? Liquidity really is access to cash. Are you going to have the cash available to pay things when you need to pay them? For those of you that read the business press, you hear credit crunch. You heard Dean Van Duzer talk about that. For those of you that read any higher ed industry publications, you heard maybe some horror stories about institutions potentially not being able to come up with cash to pay their October 1st payroll. Rest assured, we didn't have those problems, but we're watching those continually. And the issues come up with how do you have access to your cash? The university's got two primary financial institutions that we do business with right now. It's Bank of America and US Bank. And up to this point, those two institutions have weathered this storm pretty well. That's not to say they're immune from future occurrences, but thus far they've actually weathered that very well. One of the things the university has had in place for a long time to help manage its liquidity and access to cash is we have what's called an operating line of credit. It's kind of like the institution's credit card, if you will. I'm glad to say that we've just last week signed an additional extension of our credit card for another year with Bank of America, which actually provides us some assurance that if for whatever reason some of our investments go down and we're not able to access our bank accounts per se, we may be able to access that to get the cash that we need to continue operations. We have made adjustments to how our cash is invested. I'll talk a little bit later about our endowment, but we do have also some cash that we invest. You'll hear terms of money markets, short-term investment funds, and this is actually the area that some other institutions got in a little bit of bind at the beginning of the month as they had invested funds in a short-term investment fund that essentially had the trustee, the person who watches over that fund, resign. And the fund was set up in such a way that it wasn't cash. They turn around and invest in longer term, 2-year, 3-year, 5-year vehicles that in a normal market, you can get access to cash. There's someone out there that always wants to buy it. Well, as things have unfolded over the last month or so, there's not ready buyers out there. And so when the trustee resigned, it basically froze the assets of that account. And people were only able to get out the money that they had invested at the point in time that those investments matured. Now the university has money invested in there. It's a sound vehicle. It's a good practice to do it. But we had only used that to invest what we call our core cash, which is cash that we would want to maintain an overall investment strategy, but was not cash that we necessarily needed on a day-to-day basis for operations. And so when that vehicle was frozen, we were still able to meet all of our operating needs as well as then withdraw that funding when the liquidity became available. The investments have not lost money. The value is still there. It's just a matter of being able to access the cash. The other item that we've done is in our cash investments. You may have heard in the news about money markets potentially breaking the buck. Money markets historically have kind of held an asset value of $1 per share. $1 in equals $1 out, and you just make your money on interest rate you earn. Well, for the first time, there were some chances that these money markets were actually going to lose money, and that you put $1 in, you wouldn't get your $1 out. And these are vehicles that aren't under the FDIC insurance, so there is risk of losing that money. So as we have been watching this, we've been paying very close attention to the money market funds that we've been in, and unfortunately none of them have been at risk of breaking the buck. But we've been now following the trend that you see with a lot of institutions, moving funds out of those type of investments and putting them actually into treasury vehicles, which are still deemed to be one of the safer investments around. So on the liquidity front, we are sitting at a good place in time. And also as our institutional operating calendar flows, this time of the year, the calendar year, is actually a place where with the start of fall quarter and starting to receive tuition payments, that we actually do have a relatively good inflow of cash to be able to meet our operating needs. The second area I want to talk about is debt. This building we're sitting in and a number of other buildings that have been constructed on campus over the last 7 or 8 years were funded through what we call tax-exempt bonds. So we borrowed money to build a lot of these buildings. Prior to this summer, we had, the bonds were in a format called auction rate securities. Now this, I don't want to get too technical with any of this, but these are vehicles that historically they have a relatively short life over the whole bond type of market, but they had grown to such a point that people viewed them as being very liquid investments. But if you got down and you read, when I say investments for the people who buy the bonds. But as you got down and read through the bond documents, they're not necessarily liquid. If I buy one of these bonds and I turn around and want to go back to my broker and sell it, there's no guarantee that it'll get sold. It's only being able to be sold if there's investors on the other side that want to buy it. Well, people had viewed these as being liquid, and then they ended up getting caught when some of the market went sideways. And why it went sideways is that this actually started to occur. We started to see this about a year ago at this time. You heard Dean Van Duzer talk about these insurance companies and these swaps and all. Well, the auction rate security market actually was supported quite a bit by what they're called bond insurers. And bond insurers were basic people that came in and said, well, if SPU for some reason can't pay this debt, we'll step in and pay this debt. Well, over the course of the last year, a lot of these bond insurers, that's where you first started to see the impact of these subprime investments going bad, because they had turned around and invested in some of the lower tranches of those. And so the insurer that the university had with its auction rate securities basically lost its credit rating. It started out as a AA credit rating, and then as their losses started to unfold from the subprime markets, their rating was dropped to A. Well, all of a sudden there's a bunch of investors that thought they were buying AA rated debt, or actually had single A rated debt now, and were wanting to sell that. Because it was single A rated, there wasn't as big of a market for it, and so interest rates started to go up. We saw a significant spike in our interest rates last year for these investment vehicles. So, long story short, over the course of the summer, we refinanced our bonds, moved them out of this auction rate security into a variable rate demand bond. And that's basically a structure in which interest rates are reset every week and has much more liquidity for investors to come in. And it still is backed with an insurance policy, but this time, instead of having an insurance policy, we actually have a letter of credit with the bank that basically the bank then steps in and to pay the bonds if we can. And the bank that we've got our current letter of credit with is U.S. Bank, and they have continued to pay trade pretty well in the market. Now, even with this structure, to give you an idea, the interest rate that we were paid on these bonds when we first issued them in June was down below 2%. So, it's relatively inexpensive money to be able to borrow. Well, as the credit crunch began to unfold in mid-September and people were starting to flee to security, people were pulling dollars out of money market funds, putting them into treasuries, like I mentioned SPU even did. Well, money market funds are actually a lot of the buyers of these tax-exempt bonds and variable rate demand in the variable rate demand market. And so we actually saw our interest rates on our bonds when all the cash was coming out go from sub 2% to actually up to 7.25% in a period of about 2 weeks. I'm happy to say now, with some of the actions that have happened with the government and them actually coming in and now providing some assurance to the money market funds, our interest rates now are down back below 2%, so the cash that disappeared has now started to work its way back into the market. But there was a 1 month period of time where there was a lot of disjointedness in that market. Now you would ask, okay, why would a university that sets its tuition rate once a year and knows its enrollment want to expose itself to variable rates? Why wouldn't you just borrow at a fixed rate where you know what the interest rate is going to be? Well, a variable rate is a little bit cheaper to issue in the long run, but in order to answer that question, we've entered into also some interest rate swaps. And interest rate swaps are a kind of a fancy vehicle that essentially let you say you're going to borrow at variable rate, then we're going to go out and find somebody else that's borrowed at fixed rate, but they want variable rate, and we'll basically say we're going to trade positions with you. And so while we pay a variable rate to the bondholder, on the backside we find this other partner, and they pay us a variable rate, kind of passes through to the bondholders, and then we turn around and pay them a fixed rate, and therefore have a little bit more assurance on what our interest rate is going to be. So even in this 1 month where we had the spike where interest rates went up to 7.25%, the actual interest that the university paid during that period of time was more around a little bit less than 4%. Interestingly, one of the entities that we have an interest rate swap for is one of the firms that's been in the news quite a bit lately, which is Lehman Brothers. Well, Lehman Brothers is no longer in business. So what does that mean for our interest rate swap? Well, it basically means that we have an optional means to terminate the swap, and we're actually right now actively pursuing what the options for that are. Fortunately, with the environment when we entered into that interest rate swap, the interest rate environment was a little bit higher, and so because of where the rates were at the time we purchased the swap to where they are now, we're actually in a position where if we want to terminate it, we would have to make a payment to Lehman Brothers. There's no requirement that we have to do that, but if we want to terminate, we have to pay them. And that's a much better place to be than if we were waiting for Lehman Brothers to have to pay us, because you're not going to collect anything from a bankrupt company. The third area I want to touch on is endowments. Now, endowments are primarily the vehicle that the university uses to help fund some of its operations, scholarships, on a consistent basis over a really, really long period of time. One of the terms that comes with endowments is intergenerational investing. So the idea with an endowment is that $1 worth of spending today, you still have that same $1 worth of spending 10 years, 20 years, 30 years, 40 years, 100 years down the line. And so while the underlying investments in endowment may go up and down, like everybody's pension fund go up and down, anybody's individual investments go up and down, the investment horizon for those is in perpetuity. So there's not a time where we're looking to cash those out. And so that allows us to take a little bit longer term view of that, and we're not necessarily get the same kind of heartburn that you might get watching your own individual investments. Where the rub point hits the university on that is the spending that comes off of that. So while the endowments are high, you would think, okay, you've got more funds available to spend. When the endowments are low, you're going to have to cut back on some of your spending in order to kind of maintain that intergenerational equity. Most institutions don't spend their endowments based on what the current year's results were, because they don't want to have whipsaws in that, and so they spread it out over a period of time. A lot of institutions will use 3 years. The SPU actually uses a 10-year average of value of its endowment to calculate what the annual spending is. And interestingly enough, this was actually put in place right around 2000 when we saw the last stock market drop. And at that time, we're using a 3-year average, and we saw a much bigger drop in the amount of money we had available to be able to spend for scholarships by using that 3-year, because that 1 year's drop had a much more significant impact on the valuation that we were using. Whereas over a 10-year period, when it goes up, we're not going to have a big whip upward to spend on endowment. Likewise, when it goes down, we're not going to have as big of a bubble. So that should bode pretty well for years going forward. The final thing I want to talk about is enrollment. SPU is a tuition-dependent institution, and we are very dependent on having students here to help fund all the operations. And as you heard the president mention earlier, the fall has opened up very well for us. The enrollment levels that came in for the fall have been just about where we expected them when we look back last spring at where we wanted them. So for the current year, at least, things are looking very positive at that front. We're about ready to head into our budget planning phase for next year. And you can bet that we are very cognizant of what's going on in all of the markets, as well as in students' lives and their families' lives. And as we look at the budget planning for next year and trying to ensure that we maintain a solid level of enrollment, we'll be paying attention to a lot of the details of what's going on as we make those plans for future years. Thank you.
There is a question here pending for Jordan. It says, will the decrease in borrower benefit affect the benefits I was given when I came in as a freshman in 2006? The job market is already hit. Will it get worse? And my student loan is through Fannie Mae. How does this affect me? So.
All right, I'll tackle the first one here. The benefits that you received as a freshman in 2006 should be subject to your promissory note that you signed and agreement with that. But lenders have a way to have caveats and outs to those particular borrow benefits. So I strongly suggest that you call your lender and to make sure what your status is with your borrower benefit. Find out who that is, your lender is. If you don't know, our office can help you who that lender is that you agreed to repay. But that is the best advice, is to call them. The job market is already hit. Will it get worse? It's a great question. I think that's one of the unknowns, and that it depends in part upon what happens to the rest of the economy. Does the things that we talked about in the financial industry, manufacturing, marketing, start to spill over even more into other categories. The ones that you heard that are strong job growth, logically it makes sense that healthcare will still be required. Technology is still a big job producer. So those type of things you can probably go to the bank on in terms of having some type of job opportunities. My loan is through Fannie Mae. How does that affect me? I believe your loan probably is through Sallie Mae, is my guess. Fannie Mae is the mortgage for homes. Sallie Mae, that particular lady, is the student loan provider. And Sallie Mae, for everything we've heard, is still a very strong player and operator on the student loan market. And they have a very diversified account business. They do many different things associated with colleges and universities, and even outside of that. So if you're with Sallie Mae, you should be assured that they are a strong company and will remain so.
Thank you. Join me again in thanking our panelists. I think we have one last question to tee up, and then just a few closing remarks.
I'm an undergraduate coordinator in the School of Business and Economics. My question is, as a Christian, how should I respond to the crisis? And how would it be different from those who don't have the same hope that I have in Jesus Christ?
It's sort of fallen to me here at the end to try to address that question and to close us out. Maybe just to begin with, though, let me say thanks to a couple of people or a couple of groups of people that have made this possible. I want to thank Jeff Jordan, Dale and Dana Anderson, and the whole Student Life team who really organized the logistics of this and helped us put this together. I want to thank... We're doing pretty well up to here. I wanted to thank Joel Vanderhoek and the ASSP folks for their help with the program, their promotion, and really helping us shape this event for students and helping us get the word out. And then also...
losing that money. So as we have been watching this, we've been paying very close attention to the money market funds that we've been in.
And as well,
I clearly want to thank the panelists that have been here today and have given their time and their energy. So would you join me in thanking all these folks? A couple weeks ago, just as the whole crisis was starting to unfold, the market had had its first big crash. Several of the investment banks had gone down. Washington Mutual was either gone or just teetering. I went to church, and my pastor began the sermon by rattling off all of the things that were happening in the markets in a way that was kind of scary. And then he stopped, and he looked at us, and he said, "But we are Christians." And it really was a very powerful way to put it, that we are Christians, and as such, we come at this whole situation specs. We find it in the fact that we are children of God, the disciples of Christ, and loved by Him. And that should change everything. And so I've been thinking about that since I heard that. And I've tried to, this needs a lot more thinking, but I thought of 3 ways that I think Christians ought to show up in this crisis differently. The first is, I think Christians ought to be slow to the blame game here. There's a huge blame game going on. It's inevitable. It always happens. There's a very regular pattern to these bubble bursts. In the bubble burst, there's an ethical failure is revealed, and there's predictable public reaction. First, the public expresses horror and outrage. Then the public wants to pass certain legislation and statutes, and then they want to round up the bad guys, and they want to get them. And you see this. You saw it with the Enron WorldCom collapse when the CEOs were going to be arrested. The CEOs said, "Well, I'll come down and turn myself in." They said, "No, we want to come to your place of business and put the handcuffs on you and make you walk in a kind of perp walk in front of the cameras to kind of a public humiliation." We see it in this crisis as Congress has already called hearings so that they could scream at Alan Greenspan and scream at the CEO of Lehman Brothers. We've seen it well, Anderson Cooper's 360's got his little wall of shame, or culprits of the crisis. Every day he puts another face up there of a person who's bad and who did this. And what undergirds so much of this, it seems to me, in our culture is really a spirit of vengeance. We've been hurt, we've been betrayed, bad things have happened, and somebody ought to pay. And it seems to me Christians ought not to participate in that. I think there is a definite place for a sober postmortem of what's happened here and good efforts to try to figure out where it should and shouldn't, how we can fix it from happening. I think Christians can be interested in questions of justice. But there's a real reason for Christians to be humble in this area. One is, this is incredibly complicated. Hopefully you've picked a little bit of that up. What we have here is an incredible economic ecosystem. And the whole thing is out of whack, but it's so hard to figure out what one thing caused the whole thing and how you could repair it, because everything is connected to everything. So there's a reason for humility just because we don't really know. There's also, I think, as Christians, though, we have a better sense that perhaps we are not eligible to cast the first stone. And that is really, in some ways, many of us, perhaps all of us, have had a role in this. Any of us that have enjoyed our home appreciation and taken advantage of that, any of us that have bought on credit, any of us that have encouraged government policies to spend more than the government is taking in and push that debt obligation out into the future. In some ways, any of us that have participated in a credit-fueled consumerism are a piece of this whole fabric. And so there is a bit of the log in the eye piece as everybody is running around trying to find the specks that we can blame. But maybe the most fundamental reason I think Christians should be slow to the blame game is because at its very heart for us, justice is always redemptive. Justice is not about getting the bad guy. Justice is about making whole. And so Christians ought to be approaching this with a redemptive approach. And I think if we do, we will look different than our culture. And that's a good thing. So that's one thing, it seems to me, that would make a difference. The second place, as I've thought about this, that I think we should be thinking about where we go with this, is that in these times, when the economy is shrinking and everybody is scared, one of the very natural reactions is that everybody closes in. Everybody begins to hoard what they have. Everybody collapses down. And so we are absolutely assured, everybody is predicting that charitable giving at the individual level is going to go down. There'll be tremendous pressure on domestic levels to cut back on social policies or social programs that are out trying to help folks on the margins. And there'll be a significant cutback on foreign aid. That is really what is expected to have happen in this. But we're Christians. And that is a different picture. In the first century, the Christians, the little tiny Christian church, was known by the culture primarily for its generosity. It was because they shared so much with each other that they were even mocked by the surrounding culture. There's a lot of evidence that says, in historical patterns, we're going to head into an era of selfishness and closing in. And it's precisely at that moment, it seems to me, Christians need to say, no, we want to be extra generous, extra hospitable, because that's who we are. So that's the second place I think we would stand and look differently. The third is this. The world is scared. They just yesterday announced the Consumer Confidence Index for October. The number is the lowest it has ever been in its recorded history, 40 plus years, the lowest. The United States is scared. And if the United States is scared, the world is really scared, because there are many places in the world where the impact of this is going to be much greater than it is in the United States. And so people are reacting out of fear. But Christians are invited time and time again to choose whether you're going to react from fear or from hope. We have hope as Christians. In fact, we have an absolute assurance that at the end of the day, God will have his way. And that means that the shalom, the peace, the justice, the beauty, the love that God intends, that will be what will prevail. The kingdom of heaven will be, as it is in heaven, will be here on earth. We know that for absolute certain, and that tells us that in the in-between times, we can count on the fact that God is underneath this, holding this. And so we can live from that place of confidence, that place of optimism. And if we do that, we are going to look very different than the rest of the world. We are people of hope, and so we need to be careful in this tumultuous time and seemingly scary time not to give in to the panic and fear of the day, but rather to continue to hold on and really, in a sense, live signs of that future kingdom into this present reality as a way of pointing our culture to Jesus Christ. So the world is scared. Out of their fear, they're closing in, they're wanting to point blame. Christians can live from hope, and out of that place of hope, they can be generous with one another, and we can approach, at least humbly, into this allocating of responsibility. So those are some ways. I suspect if we think about it longer, as we think about it longer, we'll see other places. But this is, in a terrible way, a wonderful opportunity for Christians to be seen as truly countercultural, and in a way that will reflect and bring glory to Jesus. So those are my thoughts on that last subject, that last question. I want to thank you all so very much for coming. I know we had a number of questions that we didn't get to. I apologize to that. We're gonna keep a record of these questions, and we'll see if we can find some other ways to get some answers out to you. But again, thank you all for joining us this afternoon.